During the 1,970 seconds, a proportional relationship existed between wages and productivity. As workers increased their output, their wages correspondingly increased. This indicates a balanced economic system where earnings reflected production levels. Increased productivity directly translated into higher compensation for workers. This dynamic fostered a direct link between worker contribution and financial reward. A notable economic shift involved the stagnation of wages. This stagnation occurred despite ongoing increases in productivity levels. The result was a growing disparity between worker output and their compensation. Workers produced more, but their wages did not increase proportionally. This created an imbalance in the distribution of economic gains. Wages have not kept pace with the increasing cost of living. Debt, particularly through credit cards, emerged as a solution. Credit cards helped bridge the widening financial gap for many. This allowed continued consumption despite limited income. Debt became a common tool to maintain living standards. Debt has evolved into a fundamental aspect of modern economies. It is no longer merely a short-term solution. Debt now significantly shapes consumer spending. It also influences patterns of economic growth. This integration affects financial systems globally. Understanding debt's role is crucial for economic analysis. Banks employ fractional reserve lending as a core operational mechanism. This system allows banks to lend out more money than they hold in reserves. By lending a multiple of their reserves, banks effectively create new money. This process significantly amplifies the availability of credit within the economy. Fractional reserve lending is a key driver of economic activity and growth. Banks primarily generate revenue through interest charged on loans. The core business model relies on lending money to individuals and businesses. Interest rates on these loans are a key determinant of bank profitability. Increased borrowing activity directly translates to higher interest income for banks. Therefore, loan volume is a significant driver of financial institution profits. Inflation reduces the purchasing power of savings. As prices rise, the same amount of money buys fewer goods. This erosion of purchasing power diminishes the real value of savings over time. Therefore, inflation poses a risk to the long-term value of stored wealth. The cost of higher education has risen substantially. This increase leads to significant student loan debt. Many individuals need loans to obtain degrees. Education debt is a growing financial burden for students. Housing is increasingly treated as a speculative asset. This speculation drives up housing prices. Higher prices necessitate larger mortgages for buyers. Larger mortgages lead to increased household debt. Thus, housing speculation contributes to a heavier debt burden on households. The debt treadmill describes a perpetual cycle of borrowing to sustain living standards. Wage stagnation limits income growth, making it difficult to keep pace with expenses. Inflation erodes purchasing power, increasing the cost of goods and services. Rising costs of living necessitate borrowing to cover essential needs and maintain a certain lifestyle. The 2008 financial crisis exposed vulnerabilities within the debt system. A key factor was the widespread mortgage defaults. Millions of homeowners faced foreclosure and lost their homes. This housing market collapse significantly contributed to the broader economic downturn. The crisis highlighted the interconnectedness of financial institutions. It also revealed the potential for systemic risk within the housing sector. The 2020 pandemic created widespread economic hardship for individuals and families. Many people faced job losses, reduced work hours, and business closures. This resulted in a struggle to cover essential living expenses such as housing, food, and healthcare. To cope with these financial difficulties, many individuals were forced to take on emergency debt. This debt often came in the form of loans, credit card advances, or deferred payments. The pandemic highlighted the vulnerability of individuals to economic shocks and the need for stronger safety nets. Credit card interest rates have surged to unprecedented levels. This increase elevates the overall cost of borrowing money via credit cards. Higher interest rates make it more challenging for consumers to manage and eliminate their credit card debt. The increased cost of borrowing can strain household budgets. Consumers may find it harder to make payments on outstanding balances. This situation can lead to a cycle of debt accumulation. Banks are currently reporting record profits. These profits are largely derived from interest and fees on outstanding debts. This demonstrates how debt functions as a valuable asset for financial institutions. The revenue generated from debt contributes significantly to bank profitability. The debt system has evolved into a business model. Financial institutions generate profits from widespread borrowing. This profit is derived from individuals' and businesses' dependence on debt. The system fosters a reliance on borrowing for financial activities. The average American holds a substantial amount of debt. This debt includes student loans, a common financial obligation. Auto loans also contribute significantly to the average American's debt. Credit card balances and other liabilities further compound the total debt. The debt system is evolving with the introduction of new financial instruments. Buy now, pay later. BNPL services represent one such innovation in debt financing. Subscription financing is another emerging form of borrowing. These instruments integrate debt more pervasively into everyday transactions. Rent is increasingly being structured as a form of debt. This financialization of housing impacts tenants significantly. Late fees contribute to tenants' financial burdens. Additional charges further exacerbate the debt-like nature of rent. This creates a cycle of debt for renters. Debt involves borrowing against future income streams. Taking on debt means committing future earnings to cover present expenses. This commitment reduces the financial flexibility in the future. Future income is pre-allocated to debt repayment. Therefore, debt represents a transfer of purchasing power from the future to the present. Debt acts as a control mechanism by influencing financial decisions. It restricts the range of financial choices available to individuals. Debt can limit the ability to explore alternative opportunities. The obligation to repay debt can dictate spending and saving habits. This obligation often prioritizes debt repayment over other investments. Consequently, debt can steer individuals towards specific financial pathways. Debt burden significantly influences individual behavior and decision-making. The pressure of debt repayment often takes precedence over long-term goals. Individuals may deprioritize personal growth due to financial obligations. Professional development opportunities can be sidelined in favor of immediate income for debt servicing. Debt can foster compliance by reducing individuals' appetite for risk. The burden of debt discourages deviation from established norms. Individuals are incentivized to pursue conventional career paths to ensure financial stability. Adherence to these paths is seen as necessary for managing and repaying debts. This dynamic reinforces the status quo by limiting exploration of alternative options. Individuals should critically examine the beneficiaries of their debt. It is important to question the systemic incentives that encourage borrowing. Understanding these incentives can reveal power dynamics. This critical examination promotes informed financial decision-making. Financial freedom necessitates a deep understanding of the debt system. True financial independence is often achieved through strategic financial decisions. Effective navigation of debt is crucial for building a financially independent future. Strategic financial planning can leverage debt to create opportunities for growth. Understanding how to manage and utilize debt is key to unlocking financial freedom. Understanding the debt system is essential for sound financial planning. Awareness includes recognizing the mechanisms that drive the debt system. It also involves understanding the potential consequences of debt. Informed financial decisions require a critical perspective on debt. Awareness empowers individuals to advocate for systemic change. Systemic change aims to address the root causes and impacts of widespread debt.